You have to make this appointment like 6 weeks in advance, like you're meeting with the Pope. They make you show up an hour before the blood test. You wait there and you wait there, and finally they call you in to come on in. Then they take 2 buckets of blood out of you. Why do you need so much blood? Just in case. What, vampire straw? I don't know, whatever it is. They take 2 buckets of blood. 4 weeks later, if you're lucky, they might tell you what you have. But usually they say, we can't tell you. After all, it's only your blood. We'll tell the doctor, you ask the doctor will tell you what you have. And 6 weeks later in the US, you get a shock. You get a bill for $1,500. For what? Taking 2 buckets of blood and feeding it to a vampire? What's going on here? This is the traditional blood testing business, and this, of course, was the business that this 20-year-old is going to disrupt. If this sounds like a really interesting story for a movie, 20-year-old drops out of Harvard, disrupts this business that everybody hates. It is a true story. The person who dropped out of Harvard was Elizabeth Theranos. Dropped out, she started, Elizabeth Holmes, and she started a company called Theranos. And the promise of Theranos was, nanotainers. So basically with 2 drops of your blood, she would run 31 tests and tell you what you had in 15 minutes. That sounds great, right? You're not offering buckets of blood, you're offering 2 drops of blood. You get the results in 15 minutes, and it'll cost about 1/50th what it costs right now. Do you want the story to be true? I so want it to be true. And so did a lot of other people. Theranos became a $9 billion company. At least that's what venture capitalists assess the value. Now this is a blood testing company, right? So if you're investing in a blood testing company, what's one of the first questions you're going to ask? Does this blood test work? Seems like a fundamental question. People seem to have forgotten to ask that question. These are some of the lead venture capitalists in Silicon Valley, and none of them seem to have asked this question because in October of 2015, a journalist at the Wall Street Journal decides to ask this test. So I heard about this company, they must be doing great. When he asked the test, it turns out that the FDA had turned them down for 30 of the 31 tests, and even the 31st test, the results were too unreliable to be used. So that's how I heard about Theranos. I said, how can this happen? How can you have value pushed up to $9 billion and nobody stops and asks this question? What is the board of directors doing at this company? So I pulled up who was on the board of directors. My reaction as I read these names was, he's alive, him too. I mean, take a look at this list. You have Henry Kissinger at 92, George Shultz at 94. I mean, these might be really alert 94-year-olds. But this is, in fact, if I didn't know better, excuse me, I'd say Theranos is a CIA front. I mean, look at this. This is like a defense contractor's dream. What the heck do all these guys have to do with a blood testing company? But here's the reality. We talk about megalomania. Megalomania is not restricted just to 55-year-old males. You can be a 24-year-old woman with megalomania. Because basically this was a board created by Elizabeth Holmes with one purpose. Don't ask me any questions. It works perfectly. They're all asleep by the time they get to the board meeting. Wake up, take your medicine now. Right? Now go back to sleep. But this is what I call the runaway story, which is when the story gets so good that nobody wants. Can you imagine being that skeptic at the meeting, putting up your hand and saying, does this blood test actually work? You feel like the guy who shot Bambi's mother. I mean, you want to do this. This is such a good story. You want it to succeed. But it looks like I'm crying. I'm sorry. I'm not. I'm not that sad about Theranos. My fatalities are kicking off. So that's Theranos' story. Let's talk about the implausible. Let me construct a story again. How many of you know entrepreneurs? Are entrepreneurs tend to be shy people or overconfident people? I mean, just a generic question. Have you ever heard of a diffident, shy entrepreneur? Entrepreneurs tend to be a little overconfident, right? You're saying, where's this going? So let's say you're an entrepreneur, you're an overconfident guy. That's how you got to be an entrepreneur or an overconfident woman. You see a big market. Because you're overconfident, what do you think? Well, I think I can win in this market. What kind of big market? It could be cloud computing, it could be ride sharing, it could be China, right? So you have an overconfident entrepreneur looking at a big market. You think you can succeed and you overestimated your chances of success. You go to venture capitalists. A venture capitalist, diffident people or overconfident people? Then again, overconfident, no. These are the people you hated in high school. They already knew the answers when they didn't. They acted like they did. So you got an overconfident entrepreneur surrounded by overconfident venture capitalists who think they can pick the winner. They're all looking at that big market. Let's say you now have 9 other entrepreneurs looking at that same big market, surrounded by 3 venture capitalists who believe in that entrepreneur. Do you see what's going to happen? Each group thinks it has the pathway to success. So when they value their company, what are they going to do? They're going to overestimate their chances of success, overestimate their revenues, overestimate their profits, and overestimate their value. So when I add up the values of the 10 companies, what am I going to find? Collectively, they are going to be overvalued. I mean, I often get asked questions like, do you think there's a bubble in the tech business? And I say, I don't know and I don't care. And so what if there's a bubble? It's a feature, not a bug of these markets. It's a feature because if you have a young business and it's a big business, you are going to get overpricing early on because that's the nature of the process. People are going to overestimate their chance of success. You say, isn't that a bad thing? What's so bad about a bubble? Sounds like a crazy thing to say. Remember that .com bubble? Like 15 years ago. Most of you are too young to remember it. But it left its imprint, right? It changed the way we live. I made my reservation to come here online. I make pretty much everything online. So it was a bubble that changed the way we live. Do you think the social media bubble could be a bubble, right? But let's say it bursts. We're still going to get our news from Facebook and Twitter, not from ABC. It's changed the way we live. Bubbles are what, I mean, it's the effect of, it's human nature. I ask people, would you rather live in a world where people are over-optimistic and they overreach, which is what bubbles are, or would you rather live in a world run by actuaries? We'd still be in caves, and the actuaries saying, this fire thing, you know what, we have to study it more. It could have really bad consequences. Let me work out the properties, let me get back to you in about 400 years. It's, I think, a lesson. I was in Singapore about a year and a half ago, and they asked me to come in and talk to their market regulators. And they said, there's not much excitement here. I said, this is Singapore. This is like Disneyland on wheels, right? Basically, everybody's on camera all the time. You have a great city if I want a nice, safe, boring city. This is a city run by actuaries. A really efficient actuarial team. You're not going to get entrepreneurial bubbles in Singapore because you created an environment where that's not going to happen. You're much more likely to get it in Shanghai than in Singapore. But what regulators want is they want the good stuff and not the bad stuff. They want you to start businesses, but they want you to be modulated in your thinking. Don't be overconfident. Just be reasonably confident. What they don't get is you can't get one without the other. And here's my final example. You can't even read this page, but don't worry about it. This was actually from an equity research report done by a major investment banking analyst. I will not embarrass him by naming him. On Tesla. You familiar with Tesla? Yeah. This guy has a problem, this equity research analyst. He's a bit of a Stockholm syndrome that he's suffering from. You know what the Stockholm syndrome is?
Yes.
You know, you get kidnapped by somebody and you start identifying with the kidnappers after a while. This guy's forgotten that his role as an equity research analyst is to look at a company and ask, is this a good company? He's started thinking of his job as defending the company against all comers. He loves the company. He loves the company more than Elon Musk loves the company. He will defend it from all comers. See this buy recommendation in Tesla, where he put the stock price at like $450. I was shocked. Because I just valued Tesla on my blog at about 120. I said, what did he do that gave him $450? So I started leafing through. It was an 85-page equity research report, which should be the first giveaway that he had lots to hide. You don't need 85 pages to tell me whether to buy a stock or not. It's because you have 50 pages of stuff that you want me to read through that by the time I've read through, I have no idea what you're saying. But on page 47 or 48, he put out what he called a discounted cash flow valuation. I said, okay, this is my ball of wax, so let me see what he did. So I looked at his revenues, and his revenues actually were pretty close to what I was estimating for Tesla. So I said, this is interesting. Then I looked at his margins, and his margins were actually lower than the margins I was estimating for Tesla. And I said, if his revenues are about the same number and his margins are lower, how come he's ending up with a value that's 4 times higher? So I kept going down, especially as I got to the cash flow, and he'd done all the routine line items, all looked like he was doing a discounted cash flow. But I looked at his capital expenditures, and what I found surprising was if you look at the very top, he's actually telling you how many cars Tesla was going to sell by year. Tesla in the base year was selling 25,000 cars, and based on his estimates, Tesla would be selling 1 million cars in 10 years. Okay, you're being optimistic, that's fine. But you know what I wasn't seeing in the capex? If you're going to sell 1 million cars, this isn't social media apps. You need an assembly line. You need factories. So I called the guy and I said, you know what, I've been looking at your DCF and I don't understand something. You seem to be increasing the number of cars from 25,000 to 1 million, but you don't seem to be building any new assembly plants to produce these cars. He said, are you planning to write a blog post about this? I said, don't worry. I don't have to expose your stupidity. It'll come out on its own. I just wanted to know. He said, let me get back to you. I have to talk to my team. He had a team of 5 people who were valuing this company with him. All underlings. This guy obviously came in at the last step. So 2 days later, the entire team calls me on a conference call. They panicked. And I said, what's going on? They said, we want to tell you that, it slipped our mind. I said, what? I said that plant, we completely forgot about it. But it shouldn't matter, because our recommendation was never based on the discounted cash flow valuation in the first place. He said, so why did you put it in? Because we're supposed to. So basically you did a kabuki valuation. You made it look like you did a DCF, but you really weren't doing it. I mean, I was reminded the first time I watched the first version of the Willy Wonka movie. Remember that with Billy Wilder? And I was a strange kid. I remember coming out of that movie, and the one thing that puzzled me was Willy Wonka chocolates were all over the place, but there's only one factory. There's one factory with rivers of stuff going through it. Not a very efficient factory, right? If Frederick Winslow Taylor were designing a factory, it wouldn't look like that factory. So how the heck does one factory produce all these chocolates? And the answer, of course, is the Oompa Loompas. Right? You know, Oompa Loompas, magical beings. So I remember the last email I sent to this guy is, you better get the Oompa Loompas ready. That's the only way we're going to be able to produce 1 million cars without any plants. Maybe if we get enough Oompa Loompas, it'll all work out. This is an improbable story. I call it Willy Wonka-itis, or you prefer Oompa Loompa-itis, you can call it whatever you want. But again, that's what you're looking for. So now, how much time do I have?
You have full hour.
Good. Okay. Full hour from now?
No.
Okay.
You got about a half an hour.
Okay, good. Okay. So now I have my story. Let's connect my story to my numbers. Okay. So let me take each piece of my story and show you where it's going to show up in the numbers. How do I describe Uber? An urban car service company, right? So if I'm going to value it as an urban car service company, what's the first thing I need to figure out? Is how big is the urban car service market? This is a really tough question to answer. You know what? Because right now, before the ride-sharing companies came in, this is an incredibly splintered market. It's city by city. There are no public companies. Each city has its own taxi cab businesses. So what I actually had to do is go city by city by city, the taxi and limousine commission that city, and collect the revenues. I got this for probably 25 big cities, and I got to about 50 billion. Then I looked for the smaller towns. God help me there. So I doubled the 50 billion, and I made the total market 100 billion. I said, why double? You want to triple it? Go ahead. I put the 100 billion out as my total market in urban car service to show you how these things can take over and have a life of their own. 6 months later, I go into Google search and I type size of the urban car service market. Guess what shows up as the number one find? 100 billion from Damodaran. If only they knew. The crappy stuff I had to get from 50 to 100 billion. So what I'm saying is don't trust anything you see on Google. It could be as bad as my 100 billion. So the 100 billion that I'm using reflects the fact that it's an urban car service company. That's a total market. I assume they have local networking benefits. You say, what does that mean? I'm not going to give them a 50% market share. I'm not going to give them a 30%. I'm going to leave them at a 10% market share. Do you see how this connects to the local networking benefit? Because each city is going to be won by a different car service company. I'm not pushing them out. So the market share I'm giving them comes from that networking story. I'm going to leave their profit margins at really high numbers. Why? Because they get that 80-20 split. And because they have this low capital intensity model where they're not buying cars, they're not hiring drivers, I'm actually going to let them generate $5 in revenues for every dollar in capital that they invest. It's going to be easy for them to grow. And in doing all of this, I'm going to give them a cost of capital in the 95th percentile of US companies. It's a risky business, it's young. So every part of my story I'm now converting to a number. Now in the case of Ferrari, here's how my story. It's a much simpler story, right? I made them an exclusive auto club, which means that when I do my revenue growth, I can't give them a 15% revenue growth. Much as I'd like to, because if I gave them a 15% revenue growth, they can't charge the prices that they do. The story is connected, right? So if I change one part of it, I've got to change the rest of it. But because their revenue growth stays low, they can keep their margins at the 95th percentile. They don't have to put in any new plant. They've been building Ferraris in the same little factory in Italy since 1946. They can keep doing that. Enough capacity there. And because they're selling to these hyper-rich people who don't care what the economy is doing, they actually end up with a low cost of capital. Every number in my valuation, again, is connected to my exclusive club story. So once I put numbers on my story, the valuation then becomes almost an afterthought. Because those numbers drive my valuation. So if you look at my spreadsheet, you might think the spreadsheet was what drove me to value Uber at 6 billion. No, it's not the spreadsheet. It's a story that I'm telling about the company of being an urban car service company with local networking benefits that gives me my value of 6 billion. And if I change my story, my value will change as well. But this story, this is the value. So when you look at this valuation and ask me, why is your revenue growth what it is? I'm not going to give you a modeling answer. I'm going to tell you my story about Uber. It's an urban car service company. And this is why I think it's going to have the revenue growth that it is. If you ask me about margins, I'm not going to give you something about profits divided by revenue. I'm going to give you a story about that 80-20 split and how those competitive advantages play out at high margins. Every time you ask me a question about evaluation, what you're going to get as a response is not an equation, but what part of my story defends that number. 6 billion. What did I say the VCs at price today? 17 billion, right? And what does this prove? Nothing. It just proves that I would not have invested in the company. That's neither here nor there. I did this because I was curious. I really didn't seek out and say, look, I want to prove the VCs wrong. What do I care? It's their money. They don't throw the money at a company. That's their business. I did purely because I was curious. And this was my estimate of value. I put it on my blog in early June of 2014. I never expected it to kind of take off the way it did, because what happened was Nate Silver's site, 538, actually picked it up. And then TechCrunch, it's a big readership in Silicon Valley, picked it up. So it got into places where it normally wouldn't show up. And I talked about how that created the feedback that wasn't very pleasant, but it was actually very useful. So this is my valuation of Uber, but the story is driving the valuation rather than numbers in this spreadsheet. I valued Ferrari as an exclusive club. So low revenue growth, high margins, very little reinvestment because they don't have much growth. And what I get as my value for Ferrari is 6.3 billion euros, which works out about $7 billion. This was before the IPO. It actually went public at 9 billion about 3 weeks after I did this valuation. It's now trading back at about 6.5 to 7 billion. I don't see this as vindication anyway, because it could go back to 15 billion tomorrow. But basically, it's just the market that delivers its own judgment in what it thinks the company is worth. But again, every number in this valuation reflects a story I've told about Ferrari. At this stage, I have a story I've converted into inputs that I've converted into value. So I'm feeling really good about myself. I have a value for Uber. And this is where that last step comes in. As I said, if you go to people who think like you and you present this valuations, if I went to people who like discounted cash flow valuations and I present the 6 billion, they all agree, you're right, Uber is tremendously overpriced. Those crazy guys in Silicon Valley, they have no idea what they're doing. What's that going to teach me? Basically, it's going to say, oh, you're right, just congratulate yourself, pat yourself on the back, and then move back to your office. But as I said, it got out into TechCrunch in Silicon Valley, and I got this wave of hate mail from the West Coast. Not at this far north of the West Coast, but further down south. And usually this is how the emails will go. You cannot use a DCF to value. How dare you try to value one of ours? You can't use a DCF to value this company. And then a stream of abuse after that. And now I created a smart mailbox in Apple, and I looked up all the abusive words I could think of. I was like, you see any of these words in an email, put it in the smart mailbox, just delete it so I don't see it. But about 2 weeks after I did this valuation, I was sitting in Munich airport waiting for a connecting flight, when I get an email from a guy called Bill Gurley. For those of you who don't know who Bill Gurley is, he's one of the lead VCs in Silicon Valley. He's actually one of the early venture capitalists who invest in Uber. He's on the board of directors for Uber. And the email said, well, I read your valuation and I posted something on my blog. This is a blog post to blog post fight. It's kind of a new age phenomenon. But I haven't been very kind to you, and I just want to let you know before somebody else told you. So I finished reading his email, and guess what the first thing I do after I finish reading his email is? I go read his blog post. And here's what its headline says. Damodaran misses by a mile. Can I get it? Uber, driving. And basically he took every part of my story and said, you're wrong on that one, you're wrong on this one. And he thought I was going to be pissed off, but I was fascinated. Because let's face it, he knows a lot more about the company, and I wanted to see what he countered my story with. And here's what he said. He said, you're wrong, it's not just a car service company. It's a logistics company. Words have consequences in that. What's the essence of logistics? Anytime you have to move from point A to point B. You have a logistics company. He said we can be in moving, we can be in car sharing, we can be in rental. Notice how he's already expanded the potential market. He said we're not just urban, we're going to be everywhere. And he gave me examples of suburban cars, some of which were a little creepy, but still there. He said we can be date cars. I don't even want to go there. But he said if you want to take somebody out on a date, we'll be there. I don't want to know what these date cars look like, but you can let your imagination run wild. He said we can be mom cars. You know what a mom car is? Every day in both the US and Canada, I'm sure this phenomenon happens. Mom drags herself out of bed at 6:30 or before she gets to work. She puts her kids in the back seat and drives the kid. That's mom car. And he said we can be a mom car, which means we'll have a Uber mom pick up 5 kids. I think he was missing a little bit of what a mom car also involves. A mom car is not just a transportation device. You have to ask questions like, did you remember to put your underwear on? Or did you get your backpack? How about your lunch? So there's a combination of different services you offer as a mom, but presumably Uber will figure out a way to do it. And finally, he said, it's not just local, it's going to be global. He said, we're going to connect to credit cards. So when you land in Jakarta and you want to get a ride-sharing company, you won't want to use one of the local ride-sharing companies because who knows what they'll do with your credit card number. It's going to be global. I said, okay. I finished reading his blog post and I emailed him and I said, would you like me to put a number on your story? He said, what are you talking about? I said, you've told me a story, I can put a number on it, it's very easy. He said, go ahead. So I said, okay. You've changed my market from urban car service to total logistics. Your market goes from 100 billion to 300 billion, bigger market. You told me you think you can have global networking benefits, so I'm not going to stop your market share at 10%, I'm going to let it go up to 40%. The rest of the story kind of left intact. With those changes put in, the value that I got for Uber was 53 billion. I sent the valuation to him and he said, well, there's one thing I forgot to tell you. This 80-20 split is going to become history soon. I think it's going to be more like 90-10. I said, not a problem. I'll fix that. So I fixed it 90-10. The value that I got for Uber with his story was 29 billion. When you get big differences in value for companies, it's not because your revenue growth is different from mine, or your margins are different from mine. It's you're telling a different story for the company than I am. And if you tell a different story, you're going to end up with a different value. And in fact, in December of 2014, I decided to carry this to its logical limit. Have you ever been to a Build-A-Bear store? It's a freaky little place. Basically, you take your kid in, they give them a piece of skin, you stuff it to make the ugliest bear known to man. But it's your bear, you made it, and they charge you $55. It's an amazing concept. I don't know why I didn't think of it first. So I decided to do a build-your-own valuation of Uber blog post. Here's what I did. I let you pick what kind of company Uber was. Is it a car service company, a logistics company, a transportation company, an on-demand company? Then I said, what kind of networking benefits do you think we'll have? None, local, global. Then I said, so basically at each stage, I let you to figure out what your story would be. And then at the end of the post, I said, given what you chose as your story, this is what your value for Uber will be. So you told me, well, I think it's just, an urban car service company which is not going to bring in new people into the market. It has no networking benefits and no competitive advantages. Uber's worth 800 million. But at the other extreme, you call it a mobility. I don't even know what mobility services even means. But I guess anytime you have to move things around, it's a mobility services company. You can double the market size. You have global networking benefits. The value that I get for Uber is almost 90 billion. A few people wrote back to me and said, I don't like the value I got. Then you don't like your own story. Go back and revisit your story. I'm not telling you this is the value. This is your value given your story. All valuations are connected to the stories you're telling about a company. And with Ferrari, there's a counter story you can tell. You familiar with Maserati? Do you have any of you have Maseratis?
Yes.
There's a new, you have a Maserati? No. Okay. There's actually a Maserati that is within reach for most of us at some point in time. Not right now, but at some point in time. Maserati about 5 years ago introduced this new model called the Ghibli. It's a cheap car. It's an $80,000 car. Because they introduced the Ghibli, they quadrupled their sales over the last 5 years. You think this is good? Ferrari can do the same thing. There is a cost. Maserati quadrupled their sales, but their profit margins decreased significantly. Why? Because now you have to do marketing. You're trying to attract people who normally have not bought your car. Their margins decreased. Their cost of capital went up because now you're getting just the rich, not the super, super rich. The rich tend to be more exposed to economic ups and downs. So you can see that there is another story I can tell about Ferrari, and the story I could tell is of higher revenue growth, lower margins, more reinvestment because you now have to build more assembly plants, and a higher cost of capital. I valued Ferrari with that story. And I don't know whether you remember, the value that I got with my exclusive club story was 6.3 billion euros. When I let them grow faster and have lower margins, the value that I got was actually 300 million euros lower. At least from my estimate, Ferrari would be better off staying with their exclusive club strategy than going for more growth. But he's saying, what if I can get the higher growth and keep my margins and not reinvest? Oompa Loompas? In fact, remind yourself, Oompa Loompas should be your code word for whenever somebody goes off the reservation and starts selling stories. That can't work. Oompa Loompa time. And just to show you how you get feedback from the strangest places. I finished my valuation of Ferrari in October, and about 3 weeks later, I was on my way to Dublin. I gave a talk at Trinity College. And I must have been really bored because I was actually reading the Duty Free magazine. That's really desperation. And I got to these 2 pages, and I looked at these pages and said, you know what, maybe I should revisit my Ferrari valuation. Because on one page there was an ad for a Ferrari watch, and the other page was a Ferrari pen. There's a third story you can tell about Ferrari. It's really not a car company. It's a company that's going to attach its brand name to whatever and charge you 50% more. You could value it as such, right? Then it's not an automobile company anymore. In fact, in many investment banks, Ferrari is being put in with their luxury consumer products analysts, not with the auto analysts. There's a third valuation you can tell, which is built around this. Which brings me to my final point. I'm getting pretty close to the end anyway. So you tell this great story, you convert the story into valuation, you receive feedback, you fix your valuation, you're ready to let go. You know what, the real world is going to keep going, right? You're going to get news stories about the company come out, which is going to change your story. And those news stories can do one of three things to your story. First is they can break your narrative. So this is something in the news that says, you know what, that story I was telling you yesterday about this company is not going to work anymore. I'll give you two examples. You know whether you remember a company called Aerial. Aerial was this company that allowed you to watch cable channels on your devices, on your iPhone or your iPad without paying cable fees. Sounds too good to be true, right? In fact, the cable companies didn't like it. They sued Aerial to stop doing it. And Aerial claimed that it was legally right. The case went all the way to the Supreme Court. And in 2014, summer of 2014, the US Supreme Court ruled against Aerial. Aerial's market cap got as high as $2 billion before the lawsuit. The minute the lawsuit was decided, guess what happens to value? It went to zero. That's a narrative, right? Or here's a more perverse example. Let's say you invest in Ashley Madison. It's a big market, lots of cheaters in the world, right? You say, this is a big market, I want to be part of this market. Ashley Madison's estimated value got as high as $1 billion in February of last year. And then I had that little problem. Remember that problem? Where all the email addresses of all the cheaters got. And if you're a cheater, this is the worst conceivable thing that can happen to you. Their value went pretty much to zero almost immediately after that happened. Those are narrative breaks. The second are narrative shifts. These are small changes in your narrative. Where something happens in you say, maybe I underestimated margins, I changed. When I look at earnings reports, that's what I'm looking for. Is there something in this report that should change my story? We can have narrative changes where something happens in the company that leads you to believe it can enter new businesses that you did not think. I'll give you with Uber, almost everything, every day you open up the paper, there's another news story about Uber. Some good, some bad. So in fact, I'm going to close this process by showing you a final valuation I did of Uber in September of 2015. So what I did is I took all the news stories from June of 2014 to September of 2015, and I then categorized them based on how they changed my story. And here's what changed. In June of 2014, I called them an urban car service company. In September of 2015, I agreed with Bill Gurley that it was a logistics company. It was actually doing moving in New York. It was delivering food in LA. And that increased the market. So first thing I learned from the news is the market is much bigger, broader, and more global than I thought it was. The growth in that market was astonishing. Much higher than I projected, so I increased that. I did push up the networking benefits partly because the number of players in this business has dropped off dramatically. In the US, it used to be like 15 different ride-sharing companies. Now it's down to just Uber and Lyft, and maybe a couple of small players. So the number of players has dropped, the potential market share has increased. I left the slice of grocery receipts at 20 in my June 2014. That's already coming under pressure in many US cities, so I think it's going to drop to 15. In, I think, summer of 2015, the California court ruled against Uber, saying that their drivers were not independent contractors, they were early employees. Changes your cost structure, now becomes an employee-based model. My end result is with all those news stories, my value went from 6 billion to 23 billion. You're saying, aren't you uncomfortable that your value changed so much with a company like this? I'm not uncomfortable at all. That 17 billion that was the price in June of 2014 and becomes 61 billion by September of 2015. In fact, to show you how even small things can change your valuation. The end of summer of 2014, my 15-year-old son had a friend over. And that friend came over at 1:30, 6 o'clock, time for the friend to go home. And usually, it's a 15-year-old in suburbia, the car that pulls in to take the friend home is the mom car. I look in the driveway, car pulls in, it's a big sedan, and there's a bearded guy in the front seat. So I turned to this kid and said, does your mom have a beard? He says, no. And I said, what car is that? He says, that's an Uber. My first reaction is, I've got to go revalue the company. Because what was my June 2014 valuation? An urban car service company. Here I am in the middle of suburbia, and a mother has trusted a fourth or fifth most prized possession, depending on the day, to an Uber driver in an Uber car. So to me, this makes valuation fascinating. Everything you see, everything you hear is fair game. It could change your story, it could change the valuation. If you get a chance, go back to October of 2015 on my blog, and I valued Valiant. My fundamental problem with Valiant is they built a story that could survive only as long as they stayed under the radar. What made Valiant different from it? The typical pharmaceutical company has low margins, it's a tough time growing right now. But between 2009 and 2014, Valiant clearly broke the mold. First, they grew through acquisitions rather than R&D. Nothing wrong with that. But they acquired companies with underpriced drugs. I will leave you with the ethical dilemma of what I've just said. Now, underpriced drugs, what does that mean? That you think that you can increase the price of these drugs. Again, legally, you're on fair ground. And you're going to borrow a lot of money. So basically, they had this business model of acquiring other companies with underpriced drugs, raising the prices, and then using an online pharmacy called Philidor to push these prices on to insurers. And it worked really well in 2000. They went from being this tiny Canadian pharmaceutical company to a $100 billion company in 5 years. But even before the short sellers started isolating them, here's what you saw happening. In May of last year, I think, they were already under scrutiny from a congressional committee because when they bought Salix, which was their large acquisition last year, they got these two big drugs on which they raised prices $7,000, which is almost guaranteed to get you attention. That's a problem in the business model. And then, of course, you had the Philidor thing come to the surface because people said, what's Philidor doing? And Valiant did this little dance about Philidor. I don't know what they are. I've never met them before. Oh my God, I've known them from their whole lives. So their business model came under light. So in October, I said, you know what? I don't know about the accounting problems. I didn't know about Michael Pearson going to have trouble 2 months later. But I said, this is what I see. This is a story that has changed because it can no longer go back to the old story because now that it's under scrutiny, you can't go back and do acquisitions and push up prices and use debt to do it. It's going to have to become a more conventional pharmaceutical company. And I valued it as such. I valued it about $70 per share. And it was, of course, it was trading at $250 at its height. It's of course now at 31, 32 because it's or 35, I think 35 today, because it's now has this issue of how do you pay off the debt if you don't get the margins up. Because I think it's a classic case study of what happens when you have a business model that's built on a story, but the story works only if nobody knows you're telling the story. Because that's really what it was. It was almost like a privately told story that all these little investors within Valiant knew and talked to each other, but it was not a story that could survive the scrutiny of becoming a public story. So it's a fascinating case of how storytelling, if it falls, can bring the value down with it. So that's about it. Thank you very much for hanging in there, and if you have any questions, I'd be glad to answer.
So I have a valuation problem.
Yeah.
Donald Trump.
What is the valuation problem there?
He's not revealing it.
Oh, what's he what? The problem with real estate people is they're bankrupt even when they're worth billions, right? And the reason is very simple. You have hugely levered properties. So right now he might be telling the truth that he's worth billions, but I guarantee you, sometime in the next 5 years, he'll be worth nothing. And be worth billions again. That's real estate people, this is the way they live. They're manic depressives and they're wealth scared people. They're worth billions or bankrupt. They're worth billions. Make up your damn mind. Are you worth billions or you bankrupt? The truth is, they're both true. He's probably worth a lot simply because real estate is doing well right now. But he could very quickly be worth nothing. If his real estate properties drop 10% in value, he's worth nothing.
Well, he's a fool with licensing.
Let's face it, do you want Trump champagne? I mean, this is like Ferrari putting stuff on underwear. I'm not wearing Ferrari underwear because nobody can see it anyway. And I'm not drinking Trump water because everybody can see me drinking Trump water. So I'm not sure the licensing is real. So when he talks about his brand name, I don't think he quite gets the concept of what a brand name is. It's the same reason that I would underplay what Kim Kardashian says when she says, I broke the internet.
Oh.
Break the internet, right? So I think, it's a lot of, the brand name issue, I think we've got We have no idea. Any other questions?
Yeah, I was
Yeah.
just curious. We just might move way back for some of these guys. AOL Time Warner.
What about it?
Ted Turner was very upset. He obviously they sold out way it just got wiped out. Like there's a change in narrative right there. Back in 98, 99, we thought they would change the world, and then maybe it changed the world, but AOL blew up.
Well, I think the change in narrative also came from, sometimes the change in narrative can come from the outside, right? All those companies in the late 90s were driven by this underlying narrative of the dot-com revolution to come. And what happened in 2001, the dot-com revolution kind of imploded on itself, and it took down all the stories down with it. It's like being an oil company in Canada right now, right? It's not that your fundamental story as a company has changed, but if oil prices are $37 a barrel, guess what? The story just got a lot more pessimistic. So with AOL, I think that was the problem. It's all timing. If AOL Time Warner had happened in 97 or 96, it might have worked out. It happened at exactly the wrong time because it happened just as that dot-com boom bust, and the minute that happened, that acquisition was dead. So the story you get out of this is, you get some really stupid acquirers. I wouldn't trust them again in the acquisition game. So that's the story you get out of this. Please don't acquire any more companies. Okay? But I think that was a macro story. The macro story kind of changed, and the macro story changed the values of companies. Yes?
Well, speaking of that, growth by acquisition is a favorite strategy from time to time among
It's a
investors.
horrible strategy. Of all the strategies in the world, it is by far the worst way to grow.
But there
Period.
have been some successes, so what are the flags?
You
Red flags,
can't
all red
live
flags.
rules with the exception. If you're a company and you tell me you're going to grow with acquisitions, my first reaction is I'm selling your stock right now. It seems extreme, but the history of acquisitions, more value has been destroyed through acquisitions than any other single corporate action in history. It's the most insane process I've seen. Insane in the sense you do the same thing over and over expecting a different outcome.
Just changed the name. It used to be called conglomerates.
Well, it was one aspect of acquisitions. It's not changing the name. The motives changed, right? So each, but I think there's a reason. The process is screwed up. In what sense? The deal makers are the deal analysts. Some of you might be those deal makers if you don't take it too personally, or take it personally. I frankly don't care. You know what I mean by the deal makers being the deal analysts? Who does the analysis of should this deal be done? The same investment bankers who get paid. It's like asking a plastic surgeon if is there something wrong with my face? I mean, asking a banker, does this deal make sense? Is essentially the equivalent. It's not because they're dishonest people, but because they have too much to lose from giving you the other answer. So I think until we fix the process, acquisitions are going to continue to create these costs for everybody around them except for the deal makers. Right? But it's a horrible process. It's a horrible process. It really needs to change. I don't know how it's not changed already, but every time we talk about changing it, somehow something happens that deflects.
It just morphs.
I'm sorry?
It morphs into another one.
It could morph, but it's still, you can change the process still. The deal makers should not be the deal analysts.
We had some questions from some students. I think
Yeah.
Mehmet, our VP of Finance, has those questions.
Oh, you can bring one from there?
Hey everyone. So we got some question submissions from earlier. Okay, let's start. Can you give some comments on your thought process around valuing gold?
You can't value gold, you can price gold. You know what? To value something, what do you need? You need expected cash flows from holding. And what's the and you say, how do you price gold? Gold is a currency, right? It's an alternate currency. When do you go to gold? Is when you don't trust paper currency. You go through the history of gold. The pricing of gold has basically been as an alternate currency. So every time you lose faith in paper currencies, gold will go up. 1970s. You know what was surprising is post 2009 that gold didn't go up more. And there's a reason. There was another alternate currency that showed up on the horizon that people latched on to, which was Bitcoin. You got digital currencies, and that's going to be the issue as we go forward. Is you're going to see competition for gold as a currency. But gold's been around a long time. I don't think it's going away anywhere. but you have to price gold as a currency, which means you price it relative to paper currencies. The more you trust paper currencies, the less valuable gold will become.
I think our second question is partially answered here. How did you get so skilled at what you do? There are many people who are also professionals in the field, and even they can't get accurately,
Loaded question. How much to answer this?
and even they can't value things a lot of the time. What did you do differently to reach where you are now?
You know what? I don't care about being right in this process. And I tell people I'd rather be transparently wrong than opaquely right. That gives me a cachet. Because you get on CNBC, everybody wants to be opaquely right. You know what opaquely right is? These are people you listen to for 15 minutes and you say, what did he say again? Because they manage to say things in such a, no matter what happens, either I told you so, I told you so what? Well, look at minute 3, I told you exactly this could happen. I'm not interested in being opaquely right. The world is full of opaquely right people who give you no indication. I'd rather be transparently wrong, and you can tell me when I'm wrong, this is why you are wrong. But I can afford it. I have nothing to lose by being transparently wrong. I don't do any consulting. I don't do any, I'm not on a board of directors for Theranos. I'm not old enough. But maybe when I'm in my 90s, maybe Elizabeth Holmes will invite me to be on the board, 95-year-old. So when I go to talk at, I was at the AICPA conference, the CFA conference. The AICPA conference, they asked me, what do you want on your badge? And I said, could you put an Aswath the shit